The World Cup has just spent a summer turning American stadiums into the center of global soccer. Now you want to own a team? Not buy a jersey, not sponsor a suite, own the club. Sit beside the field, approve the star signing, and watch an entire city wear the badge you control. So you write a check for $500 million, and after the check clears, you still do not own a stadium. You do not own a training center. $500 million buys permission to begin. You do not own a roster. You do not even own the first ticket you will sell. $500 million was the expansion fee paid for the right to join Major League Soccer. It was the cover charge. That is the first paradox of this business. In an ordinary industry, $500 million buys factories, inventory, land, contracts, and customers. In MLS, it can buy permission to begin spending on all of those things. And the strange part is that the permission itself may become the most valuable asset you ever acquire. By the end of this video, you will understand what an MLS owner actually owns, why 17 home games can support a club worth more than $1 billion, how a salary budget of $6.4 million can coexist with one player earning more than $28 million, why player development can create 8-figure transfer value, and why the smartest owners may care as much about the land outside the stadium as the score inside it. Because you are not simply buying a soccer team, you are buying one protected seat inside a league, then trying to build an entire local economy around it. Before you buy, you need to understand what MLS actually is. Most soccer clubs are separate operating companies competing inside a broader league system. MLS was built differently. The league describes itself as a single limited liability company. Its club operators hold a financial stake in the league, not merely an isolated local team. You still run the local business. You hire executives, sell sponsorships, develop players, shape the matchday experience, and may finance a stadium district. But the central system controls the competition, player rules, national media package, expansion, and many of the mechanisms used to balance the clubs. You cannot place a new team in Phoenix because the market looks attractive. You cannot declare that your club belongs to MLS because you built a stadium and signed 11 players. The league must approve the market, ownership group, and stadium plan. Existing owners decide whether another MLS seat should exist. That makes MLS less like independent restaurants and more like a private chain in which every local operator also owns part of the parent company. You are not buying a normal club. You are buying a seat inside one league. Except the chain has only 30 locations representing major markets, and it is under no obligation to sell another one. MLS controls membership in MLS, not all American soccer. Other leagues can enter the same cities, and the USL plans a separate Division I competition in 2028. For you, there are two ways in. Enter through expansion when the league creates a seat, or buy control of an existing investor-operator subject to league approval. Expansion gives you a blank market and a club you must build. An acquisition may include fans, contracts, staff, stadium rights, property, debt, and history, but the seller prices those assets into the deal. Your first check does not merely buy players. It buys a position inside the system that allows the local business to exist. San Diego became the league's 30th club after an expansion fee of $500 million. Commissioner Don Garber later said the next expansion fee would be higher. The fee does not purchase a ready-made operating company. Economically, it reflects scarce league membership and the dilution created when another investor-operator joins the system. Buying an existing club avoids the expansion process, but you pay the seller for the operating business and whatever property, contracts, liabilities, and history come with it. Either route requires league approval. If you enter through expansion, you still need the local machine. Start with the stadium. New York City FC is building a privately financed 25,000-seat stadium in Queens with a stated price of about $780 million. It sits inside a larger Willets Point redevelopment with housing, a hotel, retail, public space, and a school. Inter Miami's ownership group is building another version in Florida. Miami Freedom Park covers 131 acres and combines a 25,000-seat stadium with a public park, hotels, retail, dining, entertainment, offices, and a district designed to attract people when no match is played. Now add the training complex, academy, front office, ticketing system, sponsorship staff, security, medical operation, scouting network, data department, content team, community programs, and enough cash to assemble a roster before meaningful local revenue arrives. A new club also has to create demand that an old club inherited. An established team may have family loyalty, rivalries, season ticket buyers, and corporate clients who already value the suite. An expansion club begins with a logo and a promise. That can make an entire city feel like a founder. But it requires spending before habit exists. This is why the league evaluates more than personal wealth. The owner needs capital to enter, patience to build, local credibility, and a stadium plan that can survive years of politics, permitting, construction, and cost inflation. The $500 million check gets you through the gate. 17 home games cannot carry a billion-dollar asset by themselves. The organization, stadium, and local fan base determine whether there is a business on the other side. Each MLS club plays 34 regular season matches in 2026. 17 are at home. That gives you 17 guaranteed league dates to monetize the stadium before playoffs, cups, friendlies, concerts, or other events. The limited inventory helps ticket pricing. A fan cannot attend 81 home games as in baseball. Every league match feels more scarce. But scarcity also creates a ceiling. In 2025, MLS averaged just under 22,000 fans per regular season match. Imagine your club performs close to that level. 22,000 people. 17 home games. That is 374,000 regular season admissions. Now assume an illustrative net ticket yield of $40 after discounts and ticketing adjustments. That produces about $15 million. $15 million is meaningful. It is not enough to justify a club worth $700 million, build a stadium, fund a roster, employ hundreds of people, and maintain a training system. So the owner layers revenue around the seat. Premium clubs and luxury suites can produce far more per guest than the General Bowl. Local sponsors pay to appear on the jersey, inside the stadium, across digital content, and beside the moments fans remember. Food, beverage, parking, and merchandise add value, although the club's actual share depends on who owns the venue and who controls each contract. Playoff matches add scarce inventory, but they cannot be budgeted as guaranteed. Leagues Cup, CONCACAF competition, friendlies, and special events can create extra dates. Then there are the supporters who never enter the stadium at all. They buy merchandise, watch content, follow the club online, and increase the value of every commercial partnership. This is the first major operating lesson. Match day is visible, emotional, and limited. A strong club uses the match to create a relationship that can be monetized throughout the entire year. The ticket is not the complete product. It is the customer acquisition event for the badge. The second revenue engine is media. From 2026, every MLS regular season match, Leagues Cup, the All-Star Game, playoffs, and other league competitions are included with an Apple TV subscription at no additional charge. The package is available in more than 100 countries and regions with no local blackouts. That is valuable for a simple reason. A local club can sell sponsors against an audience that is not trapped inside the local television market. But you do not negotiate an independent national streaming package for your own 34 matches. The league packages the product. That produces both security and dependence. A centralized media strategy prevents the richest local market from taking every advantage for itself. It also means the value of your media asset depends on collective decisions about packaging, distribution, production, scheduling, and access. The exact economics distributed to each club are not publicly disclosed in a standard audited format. Any model claiming to know the guaranteed annual media check for a typical owner is guessing. What we can see is the structure. Your local team creates 1/30 of the recurring competition. The league combines those matches into a broader product. The media partner distributes it. The audience increases the value of sponsorship, tickets, merchandise, and the league seat itself. This is why the weakest club still matters to the strongest one. A league cannot sell a schedule with one team. It needs opponents, credible competition, geographic reach, and enough uncertainty to make the result worth watching. Your rivals are not only competitors, they are suppliers of the product you sell together. Every owner wants their club to win, but every owner also needs the league around it to remain stable, visible, and difficult to enter. The game is the content. League membership gives you a share of the platform that distributes it, and that same platform sets the rules around your most visible expense: players. The 2026 MLS senior roster salary budget is $6,425,000 for as many as 20 senior roster players. That sounds like a hard payroll limit. It is not. The league has multiple mechanisms that allow clubs to spend beyond the budget: general allocation money, targeted allocation money, supplemental roster exceptions, U22 initiative players, and designated players. A club can choose a model with as many as 3 designated players and 3 U22 initiative players, or 2 designated players, 4 U22 players, and additional allocation money. The important phrase is budget charge. A veteran designated player can count only $803,125 against the salary budget in 2026, while the club pays the remaining compensation from its own funds. Lionel Messi's guaranteed compensation in the 2026 Players Union Guide is more than $28.3 million. One player earns more than 4 times the entire senior roster salary budget. Both numbers are correct because they measure different things. The salary budget is the league's competitive accounting system. Cash payroll is the owner's real bill. That distinction creates strategy. A disciplined club can use allocation mechanisms to build depth and turn a limited budget into a competitive roster. The salary budget is an accounting system. Cash payroll is the owner's bill. A wealthy club can pay extraordinary amounts above the budget for a star who changes ticket demand, sponsorship, merchandise, media attention, and global relevance. But the star contract is not automatically profitable. The player can be injured, performance can decline, the team can miss the playoffs, a sponsor may pay for the name while the rest of the roster remains too weak to create a winning season. And guaranteed contracts can become expensive mistakes. MLS allows limited contract buyouts, but the club still bears the cost. The salary rules protect competitive balance. They do not protect an owner from paying the wrong player. There is another way to build a roster. Instead of buying an established star at the top of the market, you identify or develop a player before the market fully understands their value. That can begin in your academy. It can also begin with scouting. Buy a young player, give them coaching and first-team minutes, then sell them into a richer market. The inputs are scouts, coaches, facilities, education, medical care, data, playing time, and years of uncertainty. The possible output is a player who improves the first team, replaces an expensive signing, or creates a transfer fee. MLS rules make the commercial incentive explicit. After recouping applicable out-of-pocket cash payments, a club generally receives 95% of eligible outgoing transfer or loan revenue. Up to $3 million can become general allocation money in a season, helping construct the next roster. The remaining eligible club share is distributed as cash under league rules. That creates a loop. Find or develop the player. Give the player minutes. Increase the player's value. Sell when the offer exceeds the sporting value of keeping them. Then use the proceeds on the next roster, academy, scouting network, or facility. Recent transfers show the upside. Inter Miami acquired Diego Gomez from Club Libertad, developed him inside its first team, and later transferred him to Brighton in a deal reportedly worth around $15 million with add-ons. Orlando City followed a similar buy-develop-sell path with Facundo Torres before his reported transfer to Palmeiras for as much as $14 million. These are development examples, not academy graduates, and not dependable annual revenue. A club cannot schedule a $15 million transfer the way a landlord schedules rent. Some prospects never reach the first team, some are injured, some leave. Some become excellent players without generating a major fee. But the structural idea is powerful. A club that only buys finished talent consumes capital. A club that repeatedly finds and develops talent can create transfer value from scouting, coaching, and opportunity. The development pipeline can help finance the next team. But because player sales are unpredictable, you still need an asset that earns when no player is sold. 17 league matches leave most of the calendar without a regular season home game. The development pipeline can build the roster and help finance the next one. Playoffs, cups, event setup, maintenance, and recovery consume some of those days. But a venue costing hundreds of millions of dollars still cannot justify itself on league nights alone. So the modern owner asks a different question. How many times can this property earn money when the soccer team is not playing? A stadium can host concerts, international matches, college sports, corporate events, food festivals, watch parties, and private hospitality. Premium spaces can become event venues. Naming rights continue every day. Retail and restaurants can trade every day. A hotel can sell rooms every night. Offices and apartments can generate rent without knowing the league table. This is why Miami Freedom Park matters more than the 25,000 seats visible in the rendering. The ownership group is developing more than 1 million square feet of retail, dining, entertainment, and office space, plus hotel rooms and a large public park. The soccer club anchors the district. The district reduces dependence on soccer dates. New York City FC's stadium is also embedded in a larger neighborhood transformation. The venue is not arriving alone. It is arriving beside housing, a hotel, retail, public space, and infrastructure. This model changes what owning the stadium means. The weak version is a building that opens for matches and absorbs maintenance the rest of the year. The strong version is an attention engine placed inside a mixed-use property. Fans create concentrated demand. The badge gives the district an identity. The stadium produces events. The surrounding real estate converts attention into rent, hospitality, food, sponsorship, and appreciation. A soccer club is not really a team with property attached. At its most valuable, it is a scarce league membership used to anchor a media, events, talent, and real estate platform. The team brings people to the address. The address gives the team somewhere to store the value. Inter Miami shows what happens when several parts of the model activate at once. Before Lionel Messi arrived, the club was already an MLS seat in a major international market with a stadium project under development. Messi changed the velocity. He raised global attention, ticket demand, sponsorship value, merchandise interest, and the club's relevance far beyond South Florida. But the cost is real. The 2026 Union Salary Guide lists more than $28 million in guaranteed compensation for Messi alone, before considering separate commercial arrangements that are not included in the union figure. Forbes estimated Inter Miami's 2026 value at $1.35 billion, with $200 million in revenue and $50 million in operating income. That operating income estimate is not net cash in the owner's pocket. Forbes uses an earnings-style measure before interest, taxes, depreciation, and amortization, and the club does not publish a full audited public company income statement for viewers to reconstruct. The team brings people to the address. The address stores the value. Still, the direction is clear. The star increased the commercial ceiling. The league seat protected the platform. The stadium district creates a place to extend the value beyond the player's contract. Miami Freedom Park is designed to remain after Messi retires. A stadium, retail, entertainment, offices, hotels, and public space tied to a brand that now has global recognition. That is the real test of a superstar strategy. The signing succeeds financially only if temporary attention becomes permanent infrastructure, recurring sponsors, a larger supporter base, and a more valuable asset. Otherwise, the owner has rented relevance at extraordinary cost. Messi is not the business model. He is an accelerator applied to a business model that had to exist before he arrived and must still work after he leaves. Scarcity protects the league seat. It does not guarantee that every local club will succeed. Chivas USA entered MLS as a Los Angeles club, connected to the identity of Mexican giant Chivas de Guadalajara. The idea looked efficient. Import a famous soccer brand into a city with a huge soccer audience and place the team in an existing stadium. The local business never became strong enough. In February 2014, MLS purchased the club and took over operations while seeking a new local owner. In October, the league announced that Chivas USA would cease operations immediately. The official replacement strategy emphasized an ownership group with resources, strong community ties, and a dedicated soccer-specific stadium plan. The league never reduced the closure to one neat cause. But those replacement criteria show what it believed the next project needed. A recognizable badge from somewhere else does not automatically create local belonging. A large market does not guarantee that your version of the product will own part of it. And Chivas USA did not have the dedicated local stadium platform MLS later prioritized for its replacement. The league did not abandon Los Angeles. It replaced the operating concept. The market later received Los Angeles FC with a new ownership group, local identity, and purpose-built stadium. This reveals the hidden risk of the single-entity structure. You do not operate a sovereign island. You are part of a collective whose board protects the value of the league. If a local operation becomes structurally weak, the league can intervene, as it did here, and reshape how the market is operated. The permission is valuable. It also comes with rules, partners, and a board that cares about the system more than your personal dream. Miami shows the upside when the seat, market, star, and property reinforce one another. Chivas shows the risk when the local machine around the seat never becomes strong enough. Those cases give us two ownership shapes to model: a club that rents much of its address, and a platform that controls the stadium and more of the economics around it. Now, let us model what ownership might look like. These are illustrations. MLS clubs do not publish standardized, audited local accounts, media distributions, stadium contracts, or transfer economics. Every figure below is an assumption. The base case uses $30 million of shared league economics in both models because no standard audited payment is public. If the real figure is $10 million lower or higher, modeled cash changes by the same amount. Scenario 1. The stadium tenant. You acquire control of an established mid-market club subject to league approval at an illustrative enterprise value of $650 million. The team averages 20,000 fans across 17 home league matches. Scarcity protects the league. It does not guarantee your local club succeeds. At a modeled $38 net ticket yield, regular season ticket revenue is about $12.9 million. Premium seating and suites adds $7 million. Local sponsorship adds $18 million. The club's net share of merchandise, food, beverage, and parking adds $8 million. Cup matches, friendlies, player transactions, and other income adds $7 million. Modeled league distributions and shared commercial economics add $30 million. Total modeled revenue, approximately $83 million. Now the costs. Player compensation and transfer spending, $25 million. Stadium rent and matchday operations, $14 million. Coaching, scouting, academy, medical, and reserve team operations, $13 million. Front office, ticketing, sponsorship sales, content, and administration, $18 million. Travel, insurance, marketing, league assessments, and other costs, $11 million. Total modeled operating cost, $81 million. Operating cash before financing, tax, and major capital work, approximately $2 million. After a $5 million capital and contingency reserve, modeled pre-tax cash is negative $3 million, before any acquisition debt service. The club is not necessarily broken. It is producing almost no current cash return on a very expensive asset. If enterprise value rises 5%, it increases by $32.5 million. If net debt is unchanged, equity value rises by the same amount. Financing costs, taxes, transaction expenses, and new capital can reduce the owner's actual return. Scenario 2. The Integrated Stadium District. Now assume the ownership group controls a soccer-specific stadium and meaningful commercial property around it. The club averages 25,000 fans with a higher ticket yield and more premium inventory. Regular season tickets, $23 million. Suites and premium hospitality, $15 million. Local sponsorship and naming rights, $35 million. Net merchandise, concessions, and parking, $20 million. Modeled league distributions and shared commercial economics, $30 million. Player sales, cups, and friendlies, $10 million. Non-match stadium events, $18 million. Property, hospitality, and venue management income, $25 million. Total modeled revenue, approximately $176 million. The integrated operation also costs more. Player compensation and acquisition, $45 million. Stadium and event operations, $25 million. Technical staff, academy, medical, and development, $18 million. Front office and administration, $25 million. Sales, content, community, and marketing, $15 million. Property operations, insurance, maintenance, and other costs, $21 million. Operating cash before financing, tax, and major capital work, approximately $27 million. After $25 million of stadium debt service and capital reserve, modeled pre-tax cash is roughly $2 million. The integrated owners spent far more capital and still produced modest current cash, but the platform now contains the league seat, stadium, event calendar, sponsorship inventory, and surrounding property. At an illustrative combined enterprise value of $1.1 billion, 6% growth adds $66 million. The owner's equity change matches that only if net debt is unchanged and no additional capital is required. The point is not that every tenant loses exactly $3 million, or every integrated owner earns exactly $2 million. The point is control. Both can be cash thin. The integrated owner controls more places where attention can become revenue and long-term asset value. Same sport, very different asset. The romantic version of ownership is simple. Choose the players, win the trophy, lift it in front of the city. The business version is more complicated. Your $500 million expansion fee may buy only the right to begin. 17 home games create emotional scarcity but limit ticket inventory. The salary budget controls competitive accounting, while designated player contracts can put tens of millions of real dollars onto the owner's bill. The player development pipeline can create transfer value, but talent does not arrive on schedule. The media strategy expands the audience, but it is controlled collectively. The stadium can become a cash machine or an expensive building waiting for the next match. And the club can lose money during the same year its value rises by tens of millions. For many owners, that tension sits at the center of the model. You are not being paid only for operating last season's team. You are holding a scarce position inside a growing league, then using that position to build a local platform around attention. The badge creates the audience. The stadium converts the audience. The development pipeline creates optionality. The league protects the seat. Fans watch the table. Owners watch the next media decision, the next sponsor renewal, the next player sale, the next stadium date, and the next parcel of land outside the gate. You paid $500 million for permission. What you build around that permission decides whether you bought a trophy, a business, or one of the most valuable seats in American entertainment. The badge creates the audience. The stadium converts it. The league protects the seat.